Personal finance practice problem using Excel. Car lease versus purchase decision. Prepare to get financially fit by practicing personal finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're down here in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information's on the left-hand side. We're going to populate that into the blue area on the right-hand side. The top section, we have our information related to the purchase and financing of an automobile, of a car. Then we have the leasing information down below, doing some comparing and contrasting. We'll first start off with just simply the cash flow comparison between the two options, and then we'll take a look at a time value of money, adding the time value of money into our calculation. So first off, we got the down payment on the car. We're going to say it's the $7,800. Monthly loan payments, we're going to assume that we get a loan for monthly payments of $1,100 a month for 4 years. So 4 years, but it's going to be monthly payments. The value of the car at loan end, meaning the value of the car still in possession at the end of the term of the loan, is $15,000. That's going to be relevant, of course, because when we look at the leasing situation, then at the end of the lease, we no longer have the automobile at that point in time. So that's going to be one of the differentiating factors. And then we have the discount rate is going to be 5%. So we're going to look at the cash flow here, and we're also going to be thinking about that value that will be on the car that we're assuming $15,000 at the end of this time period to think about this differential. So we're not going to be considering the time value of money first, and then we'll bring into play the time value of money. So we're going to say the down payment, we had to pay the down payment, is going to be equal to, let's put that into the outer column here. Down payment was $7,800, and then we had loan payments. So if we just think about the payments themselves, we will be making monthly payments of the $1,100, the $1,100 for the number of months in a year. Let's say months in, let's just say number of months total. There's 4 years, and so we're going to be equal 4 times 12 months in a year. That gives us 48 months total. So that gives us loan payments. Let's call it total loan payments, which are going to be equal to the 1,100 times the 48. That would be the total, including the interest and the principal on the loan over the 48 time periods, not taking into consideration time value of money. We're going to go to the alignment, indent. Let's go and indent this one again. Alignment and indent again. Let's put some underlines here. I'm going to put an underline under the 48 font group and underline. We'll put an underline under the 52.8 font group and underline there as well. That's going to give us our outflow. So let's say this is the cash outflow, and we're going to sum this up, equals the sum function of the 7,800 and the 52.8. That gives us the 60,600. Now that's the cash flow, but we also have the value of the car at the end, which isn't going to be cash flow. We're going to have the car at that point in time, but that's going to be a differentiating factor between this and the lease amount. So if we have the 15,000, we have the net flow, which is going to be then subtracting these out because it's the outflow, and we still have the value of the car of the 15,000. So this is going to be the 60,000 payments that we made minus the 15,000 that we still have at the end of that 4-year time period. We're going to say font group underline. That means that we basically have the 45,600. You could think of it, after that 4-year time period, net outflow payments that we made minus the value of the car that we believe is still there at that point. So we can compare that then to the flows on the lease side, and then we'll take into consideration the time value of money. So here we're going to say that the down payment on the lease to get the lease going, upfront payments are going to be equal to the 3,200. Then we have monthly lease payments. And so the monthly lease payments are going to be equal to the 950 per month for the number of months, which is going to be equal to 4 years times 12 months. So the same time frame, or 48 months. Let's underline that, font group and underline. So we have the total monthly lease payments, and let's put monthly, let's put an H in there somewhere, and we'll multiply that out. That's going to be the 9,950 times 48. That's going to be the 45.6. And then we've got the end of the lease charge. So we're going to say that there's going to be a charge, an outflow this time at the end, which is going to be that 1,500 on the payments. That'll give us our total cash outflow. And this is going to be the sum equals the SUM, shift 9 of this entire thing. So that gives us an outflow of the 50,300, font group and underline. So just looking at that, it looks like the outflow here for the lease then being higher than for the car, for the purchase. So this is probably the first kind of comparison that we have. And then, of course, the differentiating factors here is that the lease then will terminate at that point in time. We no longer have use of the car, whereas if you're talking about this scenario up top, we still have the ability to use the car after the 4 years or to sell it if we believe we could sell it for, at that point in time, the 15,000. So you got to take that into consideration in terms of, do you want to be in a situation where you want to be selling the car, or do you just want to, lease and get a new lease after that time period? Possibly that could be easier than managing the purchase and whatnot of the car and just paying for the use of the car and so on and so forth. There could also be tax implications that could be the case, especially if you have business relations with it. And then you can kind of think about this in terms of a time value of money type of calculation. So if we assume a discount rate of the 5% and we have this 4-year period that we're looking at into the future, then we could say, well, we should be using the time value of money calculation and think about those outflows that are happening and use the discount rate of the 5%, given the fact that we're not talking about even outflows each year. So in other words, in this case, we put a larger amount down on the 7,800 than we had on the first down payment, and then we have differences in terms of the payments each year. And so we should be, since they're being paid at different time frames, we should be accounting for that with basically time value of money concepts. So one way to do that, I think this is the easiest way to set up a table for that, is to set up a vertical table with periods, cash flow, and present value. We cannot use just a simple annuity calculation here because the cash flow payments get confusing going out into the future. They're different when you think about them out into the future. So what we can do is just basically take the present value of each cash flow. And this is a common type of scenario. You could use this for budgeting. You can use it for this kind of comparisons between different scenarios of a lease and a purchase and so on. When you see future cash flows that are going to be different, and even with different time frames, meaning you have one thing, possibly the loan for, say you have a loan for 3 years and then you're going to lease for like 5 or 6 years or something like that, and you have some difference in the overall time, then again, you could take into consideration the time value money in a similar fashion and try to compare those two things that are different in time frame and when the payments are going out. So to do that, we're going to say I would usually set up the periods and then put the periods on the left by saying 0, 1. I'm going to select those 2 periods and I'm going to drag it on down to get to 4. And then we actually have 2 period 4s here because what's happening is we got the down payment up front. I'm going to say that's in period 0. And then we're going to have 4 payments of the 1,000. I'm sorry, we're going to have 48 payments of the 1,100, which I'm going to annualize. We're going to annualize those payments. So we'll put these in periods of years to take a look at them. And then we're going to have at the end of this thing, 15,000, which is also at the end of the 4-year period, at the end of period 4. So we'll put that also at the end of period 4, and I'll break that out. So let's see what this will look like. I'm going to center this. I'm going to go to alignment and center. We got the initial cash outflow. I'm going to put the cash outflows as negative on this type of calculation. So I'm going to say negative of 7,800. Obviously, most of the items are going to be outflows because this is what we're talking about, paying for something. And then we're going to say that yearly payments then will be equal to the 1,100. I'm going to multiply times 12 for the outflow of 13,200. So same thing down here. Again, you could do it this way and pick up that B2. I want to copy this down, so I'm going to put my cursor in B2, select F4 on the keyboard, $sign, but between the B, before the B and 2, so that when I copy it down, it will not move as we copy it down. I'm going to say enter and put my cursor back on that and put our cursor on the fill handle, drag that down to the 4 periods. So on a yearly basis, we've got cash outflows going out of the 13.2 and so on for 4-year time period. So then we're going to pick up what happens at the end of year 4 is we're going to have this 15,000, which is the value at that point in time, which we could sell it for, we're assuming, if we want to, or continue using the car. If we sold it, we would have the cash inflow. So I'm going to call this a cash inflow of the 15,000 at the end, a positive number. So let's total this up. Total, I'm going to sum up this column, equals the SUM. We should get to the same number we got here. We'd represent it as a negative number on this side. Then I'm going to present value each of them using our discount rate of the 5%. Now, when you use the 5%, you could, inflation might be between like 1 and 5. And then you're also using basically your opportunity cost in the consideration of what the percent would be, meaning what else, could I be doing with my money to basically get a return on the money? In other words, if I wasn't purchasing the car, if I had the money, could I be putting it, somewhere else and getting a return on it of, say, 5% on it or something like that? Now, obviously, if you're in a situation where you have to buy the car, it's just for a functional use type of situation in order to do other things, and it might be just basically the inflation rate. Or if you're thinking about how much you want to invest in the car versus having your investment in some other type of thing, the opportunity cost that you could get if you were to put your money elsewhere would be basically what you're thinking about typically for the discount rate. It's kind of like the required rate of return rate typically. So those are some ideas. So generally it would be between 1 and 3% at least for inflation that you'd be dealing with, just the purchasing power of money going down, and possibly, of course, higher than that, given the opportunity cost of the money, which you could be doing with the money if you were to use it in some other fashion. So we'll put the 5% here. Then we'll do our present value calculation for each one, and we can copy it down nicely if we set the table up this way. We're going to say present value, negative present value, shift 9. The rate is going to be that 5%. Now to copy this down, I'm going to say F4 on the keyboard. That puts a $ before the B and 5. You only need a mixed reference, but an absolute one works, so that when I copy that one down, that cell does not move due to it being outside the table. Comma, number of periods, I'm going to say 0 in this one. So this is actually period 0. That means it's going to come up with the same number, but I would still put the actually present value calculation in it so that this whole column is uniform in nature. And then we can copy it down, and then we're going to say comma, the payment. We don't have a payment because this is not an annuity, so 2 commas. We're going to pick up the future value, which is that 7,800 future outflow. I'm going to say enter. We get to the same number because this is period 0. If I copy it down, though, then it's going to give us our second kind of calculation. Now, I'll delete that and do the calculation again, and then we'll copy it down. So this is going to be present value, shift 9. The rate is going to be this 5%, F4 on the keyboard, $ before the B and 5, comma. Number of periods is now 1. Notice that we're bringing this periods when we get to that number of periods from this column, which means it copies down nicely instead of hard coding the number 1 here, in which case we'd have to hard code it each time down. So it copies down nicely if you add that next column. 2 commas, because there's not a payment. We pick up the future value of that 13,200 and enter. So now, of course, if we discount it back, we have a outflow of the 12,571. Putting our cursor on the fill handle, dragging that down, and it does it all the way down here. On period 4, we had that last outflow. Well, let's do it down here. If we got the 13.2 2 years out, discounting it back, 5% for 2 years gets us to the 11,973. The 13.2 3 years out, discounted back 3 years, 5% brings us to the 11,403. The 13.4 discounted 5%, bringing it 4 periods back, 4 years, 10,860. And then we have the 15,000 value of it after this whole thing is over, after 4 years as well. 15,000, which we could sell it for, which could be a cash increase. And we discount that back 4 years, it's worth in current dollars, period $0, 12,341. Summing this up equals the SUM, shift 9, and summing that up, we get the 42,266. Let's put an underline, font group and underline. We could do the same thing then for the lease payments. So we're going to say period 0, 1, 2, selecting those 3 cells, auto-filling down, centering, font group or alignment group, and center them. We're going to say the cash payments are going to be, I'm going to say negative of the 3,200, and then that's the first down. And then for the next 4 years, we're going to say that we have negative the 950. I'm going to select F4 on the keyboard so I can copy that down times 12. So we'll copy that down, putting our cursor on the fill handle, dragging it down to period 4. And then I'm going to make this period 4 as well, because at the end, we're saying after the 4 years, we also have this lease charge of 1,500. That's an outflow. And then the car is out of our hands. We don't get the value of the car after that point as we would if we owned the car. And so we don't have this positive flow at the end. We just got the termination of the lease at that point. So the totals then, if I sum this up, equals the SUM of these items. We're going to get then the 50,300, same here. But now we're going to apply the time value of money. And notice this can be significant due to the fact that this cash flow has more going out in time period 1, more going out in the first couple time periods here than this cash flow. So even though it's lower, even though this is lower, because we kind of front loaded the cash flows, it could have a significant difference in terms of the timing difference. Whereas here, I have a lesser payment up front and the lesser payments, even though the total payments are higher, you could end up in a situation where, paying later on, if we're not paying till later on, then due to time value of money, it could have an impact on the decision-making process. So we're going to say negative present value, shift 9. The rate is going to be this 5%. I'm going to say F4 on the keyboard so we can copy it down. That puts a $sign before the B and 15. You only need a mixed reference, but absolute works. Comma, number of periods is going to be that 0, which is going to give us the same number for this first one. Comma, comma, to get to the future value, and that's going to be the 3,200, and enter. Now we could copy that down, and that would give us the next one here, but I'm gonna do one more of these and then copy them down. Negative present value, shift 9. Rate is going to be the 5%. F4 on the keyboard, $sign before the B and 15, comma. Number of periods is going to be 1. That then is going to copy down as we go, 2 commas to get to the future value of the 11,400, and then we'll go ahead and copy that down. So I'm going to say enter, putting our cursor on the fill handle, dragging it on down. There we have it. So that means that the 11,400 discounted at 5% 1 year out gets to the 10,857. The 11,400 2 years out discounted back 5%, 10,340. 11,400 3 years out discounted back 5%, 9,848. And 4 years out 5% discounted back 9,379. And then this 1,500 discounted back 1,234. Let's go ahead and sum this up. Equals the SUM. Equals the SUM. And that gives us the 44,858. Let's font group and underline it. And so there we have it. So we still end up with the purchase being better in terms of cash flow, 42,266 versus the 44,855. Note you change this rate. Let's say it was like 17% or something, just to have a significant difference on both of them. Then now we're at a situation where this one is higher on the lease than the purchase. But if you take into the situation the time value of money, you have the lease being less than the amount for the car purchase up top. And that's, again, due to the difference in the cash flow. We had more money up front on this one, and therefore that's going to be costing more because the money's up front versus this one where the money's going to be less when you take the money up front. So that's where the time value of money can have an impact on these longer term decisions. the longer the term decisions, the more, out in the future the decision is, then the more that time value money is going to be and of importance, of impact typically. So I'm going to bring this back to the 5% there. So we're at the 45.6 and the 42.266 and the 50,003 and the 44.858.